Hello, I welcome you to this learning session on IFRS for SMEs, session 3 and lecture number 5. In this session, we will be discussing about section 4 of IFRS for SMEs, which deals with the requirements relating to statement of financial position. So, let's start. After completing this session, you would have an understanding about the following areas. The first is the objective of this section, the presentation of assets and liabilities, definition of current assets, current liabilities, and format and the order of financial statements. So let's start. The primary objective of this section is to provide guidance regarding the information to be presented in the statement of financial position and the way of presenting it. Now, it specifies, suppose this is a balance sheet, it specifies what are the items that to be included in the balance sheet. Along with that, it specifies generally what are the different classes in which these assets and the liabilities are required to be shown. So as per section 4 of the IFRS for SME, as we've already discussed, IFRS for SMEs deals with sections. They do not have separate IFRSs. The assets and the liabilities are required to be classified as current and non-current assets and liabilities and presented accordingly in the statement of financial position. So which means if this is the statement of financial position, or the balance sheet, you have a horizontal. So here it will come non-current. You will put all those assets, all liabilities which is falling under as non-current. Then you have current, which means all of those assets and liabilities which satisfy the definition of current and non-current, current, and they will fall under this category. So basically they specify the categorization of the assets. However, the entity may present the assets and liabilities in the order of their liquidities. If this is the case, then in such a case they don't need to present assets and liabilities based on any current and non-current items. This basically I saw in case of banks. Think about it. This is the financial statement. Suppose cash, debtors, and any, for example, investment property, land. It will be surprising they are not classifying under anything, but this is classified and the order is based on the liquidity, how liquid these assets are in terms of the other assets. So this is order number 1, order number 2, order number 3, and this order is based on the liquidity. This is same applicable for the liabilities as well, which are payable first. For example, accounts payable, some accrued expenses, then long-term liabilities, short-term portion of the long-term liability, the long-term liability. So everything will come up like this. So which means the point is either you can classify the assets and liabilities as current and non-current, or either current and non-current, or either you can use the liquidity-based ordering. Here there is no order, but here we have an order, which means you need to present the assets and liabilities based on the order. The requirement is similar as compared to the full IFRS, so no change as compared to the full IFRS. So let's move to understand what do you mean by current assets. Current assets means these, if any of the assets, these are ORs. If the assets specify any of the following criteria, for example, if the assets are consumed within the operating cycle or helpful trading purposes or expected to be realized within 12 months from the reporting date, not from the transaction date, from the reporting date, cash is explicitly mentioned. And all the other, and apart from these assets, everything is classified as non-current. And under IFRS, full IFRS and in the SMEs also, deferred tax assets are always classified as non-current assets. So if the asset satisfy any of the below criteria 1, 2, 3, 4, then in such a case that asset is termed as current assets. So now before moving towards our next section, let's understand what do you mean by an operating cycle. It means the time taken from the purchase of material to the collection from the ultimate receivables. So this is what we call as P2P, procurement to payment. You procure the raw material, produced it, sold it, and ultimately collect the dollars. So this entire cycle is called operating cycle. And do not confuse operating cycle with cash conversion cycle or net operating cycle. So basically, in order to calculate the operating cycle, what we do is like we just add the days of inventory, which means how many days the inventory lies in your factory or in your godown, plus the days of receivables, which means how long it takes for you to collect all the receivables after the date of sales. So in order to calculate the operating cycle, you need to add the days of inventory plus the days of receivable. You will get the operating cycle. So now let's move into current liabilities. The same thing is also mentioned in the current liabilities. If it is consumed within if it is settled within the operating cycle, if it is held for trading purposes, or it is due to be settled within 12 months. Now sometimes one may have confusion regarding what are the liabilities which are held for trading. In case of assets, we may say it's inventories, but in case of liabilities, we can say that derivative. If you are dealing with any financial instrument and which is your business, you trade you trade on a daily basis. In such a case, sometimes the derivative may be an asset for you, or sometimes it may become a liability. Or in another instance, you can talk about credit default swap. You trade on CDS, or you trade on any credit derivative. So that may be a situation where you need to classify any liabilities as held for trading purposes. Any And if the entity does not have any right to defer, maybe I can call it as demand payables. If the liability, or if the lender has the right to call the money immediately and you do not have any right to defer it to at least 12 months from the reporting date, then in such a case you need to classify as it as it's a current liabilities. So another case is there in respect of, I'm sorry, another case is there in respect of any loans. If there is a breach of loan, then the same thing applies whatever it is mentioned in the IS1. So the same section or the same protocol we need to follow in case of any breach of loan which makes the loan demand payable. Now let's understand the format and sequencing. One thing please keep in your mind, just like IAS1, IFRS for the SMEs does not specify any kind of format for the statement of financial position. It only specifies the minimum items that need to be included in the statement of financial position. So it does not provide any kind of a specific format, and it specifies the minimum items that need to be included in the statement of financial position. And also it does not specify any kind of order, like you have to mention PP&E first, or then inventory, or cash, then debtors. No, it can be either go by non-current assets, put it here, and all the non-current assets will form the position, and current assets, and all the current assets will come up here. Or in case you are following the order of liquidity, then in such a case the order protocol will follow, which means you show the assets on a descending order based on the liquidity. For example, cash is the most liquid, then the debtors, and the inventory. This order we need to comply in case we are following the liquidity approach, which is generally followed by most of the banks. So thank you for this video, and we will discuss on the statement of financial position in the second session. Thank you.